Good afternoon, everyone, and welcome to this panel. My name is Mathieu Favas, and I'm the Economist Finance correspondent. I cover banking, fintech, and a few other topics at The Economist for the paper. And I write regularly about trade finance, so really excited about this conversation we're going to have today. The questions we're going to address is what will it take to democratize and decentralize trade finance? We'll look at topics like automatization and digitalisation, and we'll take a pretty global outlook as well. We are very fortunate today to have a very expert and distinguished crew to discuss this. Christian from Tradeshift, Cathy from Nextrade, Jordan from Standard Chartered, Ziyang from the World Economic Forum, and Ami from Windward. We have displayed their bios that you can consult yourself. So I won't spend too much time introducing everyone so that we can have a bit more time to discuss the key questions we need to cover today. There's quite a lot of ground, so we'll get started promptly. And I guess where I would like to start is perhaps with the first part of this question that I just mentioned, which is democratization of trade finance. So we very often speak about the trade finance gap, meaning the amount of trade transactions that don't happen because either party can't find the financing needed to make it happen. And I would like to start perhaps by diagnosing this trade finance gap a little bit and understand a bit better what we're talking about. So first question, how big is this gap? Is it a big gap? How has it been growing over time? Perhaps I would ask you, Cathy, first, if that's okay with you.
Well, thank you very much. Well, the numbers that have been cited are, of course, very large, $1.5 trillion trade finance gap. And some of that is supply chain finance. Some of it may be conventional trade finance like letters of credit. Still other things could be things like working capital. What we have seen in our work with SMEs in e-commerce, which has, of course, boomed in particularly developing countries this past year, is that SMEs that are now entering marketplaces are very interested in exporting and are able to reach global customers by virtue of e-commerce. However, they still need the export working capital solution in particular. This comes up as one of the top three constraints typically for SMEs to engage in trade. So there are a number of different kinds of financing gaps that need to be bridged. And perhaps, we can think about new solutions also, like embedded finance solutions on marketplaces to enable SMEs to quickly get this working capital gap fulfilled. And of course, digital identity solutions that we'll probably touch on this panel also enable SMEs to quickly authenticate themselves with finance providers and thereby get financing. And perhaps this solution will enable trade finance also in other ways, such as supply chain finance and traditional trade finance.
Thanks, Cathy. Indeed, I think we'll get to some of these topics a bit later in the conversation. But just before we do that, I think I'd like to understand also a bit better who is most affected by this trade finance gap, who is lacking the most trade finance, basically, in terms of perhaps the size of companies, the sectors affected, or the geographies. Ziyang, do you want to tackle this one?
Yeah, sure. Thanks for having me here. Yeah, the number is huge, 1.5 trillion. Some would argue that it's a lot bigger than that. It's as big as 5 trillion. So in any ways, there's a huge gap that we're dealing with. I think, as Cathy said, the SMEs and particularly the business in developing countries are hit hardest by this gap. I think, to answer your question, how do we address it? I think, there's two ways from the technology perspective and from the policy perspective. Just quickly on the technology perspective, we'll spend the rest of this our panel discussing this on digitalization. But I think one key point is the reason for the lack of, one of the main reasons for lack of financing for SMEs is lack of data. Or the data they have doesn't fit into the neat traditional banking system, right? So that's the financial services institutions don't know or don't have or don't know what to do with the small SMEs data. So I think that's a real challenge. I think that's where one technology can play a true key. And we just share two quick sets of data. One is that 45% of the deals fall through the applications for trade finance rejected because of lack of data. And for those who are rejected, over 60% the deals fall through. So it just shows you how important it is. And then just quickly on the policy front, of course, we also need, in addition to technology, we need an enabling policy environment from digitalization to e-bills, leading e-invoices to allow that happen. So I'll stop here and happy to chat more later. Thank you.
Just for clarification, Yang, I wasn't sure. Typically, this trade finance gap is accounted for by companies whose requests are rejected, or do some of them not even bother to ask, or what is typically the case?
Yeah, so I think of the ones who were rejected, 45%, as mentioned, for lack of data, and I think because of that, there's a culture. I think some SMEs, as you said, just probably don't bother, or they don't have the means or the technical knowledge to do that. So it's unfortunately it created this downward spiral, which I think all of us here try to flip it around and make it an upward spiral and to involve more into global trade.
And Jordan, of course, Standard Chartered operates in many emerging markets. Would you share the diagnosis that's been made so far in terms of this trade finance gap getting probably worse? And also, since you work for a bank, what are the main reasons why typically demands are rejected?
True, thanks, and thanks for having me here. Look, the reasons that have been highlighted and the gap being mostly focused on the SMEs in developing markets is really what we've seen as well. And correctly, this is largely due to the need of data and basically on the way the credit assessment works and the fact that when you're talking about SMEs, you're talking about large-scale operations instead of gathering documentation and data to do a proper credit assessment, which then would benefit largely from, as was mentioned, embedding the process into supplier networks or marketplaces that could provide some of that data and could help the automation of the credit assessment. So that's definitely something we've seen, and we're working on as well to find ways and avenues to automate the credit assessment with new source of data which we can get from the move of the global trade finance marketplace space into marketplaces and supplier networks.
Are there any particular regions or countries where the problem is worse? Given your broad outlook on emerging markets, I was curious to hear your views on that.
If you look at the footprint of the bank, we've seen that being more acute into the various regions which are the core focus of the bank. So Africa, Middle East, and Asia, and really on the developing markets in these three regions, right? Clearly not something that is really an issue in other markets like the Americas or Europe. So that's really what we've seen again, what was before, in terms of that gap being acute in the developing markets.
And Christian, welcome to the panel also. So the lack of data has been mentioned as one of the main factors for this trade finance gap being so big and growing. Do you see any other reasons? Do you think that's the main one?
Yeah, no, I think so. First off, this is, as Sharon and Jordan and Kasi has pointed out, a complex problem. First off, large companies have access to supply chain finance because their buyers, meaning the customer, don't mind sharing the data with the bank because they want to give benefits to their large suppliers, right? So if you're a large supplier, you can get very cheap supply chain finance because your customer is sharing the approval data. Yes, we have approved the invoice, so it's a no-brainer to finance it with the bank, right? They're not sharing that data with their small suppliers for many different reasons. One is there's very little benefit overall for the large buyers to do it. And as Jordan pointed out, for the banks, it's a big administrative challenge to take on all of these smaller customers. So the only form of supply chain finance that's really available for SMEs globally today is pretty much factoring, which is very, very expensive, or even, as we see in North America, credit cards, which is even more expensive, right? So I think really, and don't get this wrong, I don't think the bank can solve this. We need, to have electronic platforms in the middle because the data needs to be democratized. It's not so much democratizing supply chain finance; it's democratizing the data, right? And what's ironic here is the data that the supplier need is actually their data. They need the data that they have sent an invoice that's electronic stamped and signed, that they can see is authenticated and received by the buyer. Because if they have that, any source of finance can pay it. So one of the things we've been doing is we've been democratizing that data and essentially giving suppliers control over their own data from these transactions, right? So if I send a physical invoice in paper, I have a copy of it and the buyer have a copy of it, right? And now in today's world, the buyer might call me, I might call the buyer and he says, well, your invoice is approved, wait for it to be paid. But in the electronic world, the buyer now sends an electronic message saying, we've approved your invoice, it will be paid in, let's say, 60 days. That electronic message is really, really important because it's now signed electronically by an electronic ID belonging to the last buyer, which makes it a no-brainer again to finance it. So I think, the good news is once you have that data, you can open up to many, many different sources of financing, banks being one, but also a lot of other players, right? And I think we're about to see a complete revolution of the players who play in finance because we're democratizing the underlying data. So it's not supply chain finance that needs to be democratized, it's the data and access to the data. And if we can give suppliers access to their own data and control of that, there's more than enough capital in the world that would love to make, 4, 5, 6% a year in a world where there's pretty much no yield, right?
Thanks, Christian, for the hopeful message. Kati, I think you wanted to add something?
Yeah, just to add to what Christian said, I agree that there are alternative providers now that provide these solutions. And we did some work recently in Mexico where there's a vibrant fintech space enabled by the government's regulations on fintech sandboxes and so forth, as well as a very vibrant e-commerce market where SMEs are entering trade using e-commerce marketplaces. And we found that SMEs that are needing trade finance or export working capital go to fintechs that lend to them within a couple of hours, maybe minutes, approve their loan application. And these are oftentimes very small amounts that are not probably interesting to banks, are extremely fast dispersing working capital solutions, are something that the SME pays very quickly, but they need this working capital in order to fulfill the order that comes online from an impatient customer that they then need to fulfill and can repay quickly to the fintech. And we see this as a promising model, potentially using fintechs and merging marketplaces and fintechs more together, enabling lending solutions directly through marketplaces. And this is, of course, happening, particularly in Latin America. We're seeing a great deal of innovation in this space where marketplaces are including finance solutions. And I would say there's a big opportunity for export credit agencies also to underwrite small loans for small exporters using the data from marketplaces and potentially using data that's embedded in a digital identity that an SME might have.
Ami, I'd like to involve you here because I know you work closely with the banks and also with the rest of the ecosystem. And so first of all, do you share the diagnosis that's been made so far? What are the main pain points typically for big banks? And secondly, what do you think should be the role played by other players in the ecosystem, say the fintechs, say export credit agencies?
Yeah, so thank you very much, and thanks for having me. So quick note, I think we all heard about supply chain issues in the last year or so. Basically, the price of ocean freight has gone up 10x in the last year, and that's a huge issue, especially for small exporters. Just because sometimes you could have financed another way, but sometimes the cost of freight is just too big to finance in different ways. So I think that's one. Number two is the predictability of arrival of your merchandise. So port congestions are and irreliability or unreliability of arrivals is at an all-time high. From 80% arrival on time, we're down to about 40% arrival on time, by and large. And just recall the following names: Vientiane, Suez Canal, LALB, right? And we're just getting started. So I think this is very, very important context. The second important context is that banks are just under such regulatory pressure to scan this and manage risks at scale. While on the other hand, they're moving slow. Sorry, Jordan, but they're moving slow as a community. And they're not using AI because sometimes they're regulated, but sometimes they're just, it's just culture. So I think a lot of if you talk about the combination of issues in arrival logistics and the ability to predict that to provide more effective supply chain trade finance, plus the ability that you have to meet regulatory expectations, otherwise you cannot lend people. It doesn't work this way. It's regulated, whether it's the FCA or whatever authority, and you have to do that at scale, and therefore that leads to the last problem, or I think one of the last big challenges is false positives. Basically, one of the challenges with banks is there's so much false positives that sometimes you just can't do business. I'll just give you one mind-boggling number, and I'll hand over to Christian. Is one of the big banks we're working with need to scan 20 to 30 million transactions a month. So the difference between 10% false positives, which you have in shipping without AI, or 2% that you might have with AI, is so big on a monthly basis. So, and I think that's probably one of the factors that Xingyang mentioned about 75% of the applications falling, if that makes sense. Christian, over to you, I guess.
Yes, Christian, I think you wanted to add.
So, sorry, just two really quick points, right? I mean, we're talking about the networks like us. We move around $500 billion of trade now. We have around a few million suppliers and buyers. We are probably one of the largest concentrations of trade in the world. And one thing I want to make very clear is, I think the banks and everybody else also need a very different mindset. We're not just going to hand the data over to the banks so they can do finance. We are going to set terms that benefit our suppliers, right? And I mean, think about what's happening in general in tech. Amazon is building better finance solutions for their supply chain. Apple is building a better credit card for consumers. We feel a big obligation to our end users to provide a better experience. And I think for many years, when we came to the banks, they said, oh, yeah, you got to do what we want, and we'll pay you a little for the data, and you can plug it in here. But I think it's actually the inverse relationship. We own the end customer. We have massive sets of data, probably one of the largest proprietary data sets in the world. And we're going to use that to the benefit of our buyers and sellers on our platform, right? And we will let anyone. And I think that's the good news for the banks. In fact, I think this solves a problem for them. If you look at Lending Club, for instance, in the consumer space, the banks are now one of the biggest buyers of loans because Lending Club allowed them to aggregate a form of risk that's hard to get into for the banks individually. So I think what we're going to see is also a change in the role of who owns the front end of the ecosystem and who owns the back end. And then one last point about the democratization, and I know I took a lot of comments, the other thing that's happening is, and I think people are not noticing, is buyers is about, so right now when buyers underwrite supply chain finance as they do for the large suppliers, there's a massive accounting change on the way. All of the big four accounting houses have said that if it walk like debt, talk like debt, and look like debt, it's probably debt and it should be on the balance sheet. And with Karelian, with Greensill, with all of these happening, there's a very big risk that if you're running $1 billion supply chain finance program in your supply chain, technically not your debt, but you would have to put it in the balance sheet in the future. And if you're a CFO of a large Fortune 500 company, you're not taking $1 billion hit on your balance sheet just because your suppliers can get paid early. So the democratization we're talking about is also about to happen just because of all of the accounting risk that's sitting on the balance sheet. It will have to move to the seller side, and moving it to the seller side means we need to have a completely different and very decentralized model.
Thanks, Christian. I think, Jordan, you deserve a right of response. So here's the mic for you.
Thank you, Mathieu. It's not so. I think we have here what we have is a business case for collaboration actually, and this is a who's gonna tackle the issue and solve the entire issue by himself. This is what we've seen actually with our valid right of pace of execution, time to market of some of the solutions, but there's also an element of relationship with the large firms, footprint. Trust of the institution that is providing the financing, combined with an element of technical expertise around digital solutions that is coming from fintechs as well. And what we've seen in where we've been the most successful actually is where we had proper collaboration between the banks, the fintechs, sometimes the regulators, to come up with those new solutions. Because as was said, right, this is a regulated environment and a regulated market, right? And the point is that it's not because you are a bank that you're regulated. It's because actually you are providing financing at scale. Eventually, regulators will play a role in shaping also what is available to the market and what is not available to the market. And so by combining those joint forces together, providing solutions in the markets in need, is where actually we see solutions coming through by really coming together. On the point of the amount of data that can be processed, I think banks themselves have historically also a number of transactional historical data of transaction patterns and payment patterns and trade patterns. So that is being used by the banks themselves as well. The question is, who do you collaborate with to basically come up with a new set of solutions to be able to change your credit assessment model, to have a better predictive model, and that is coming, both from the banks and externally as well, and again through collaboration, coming up with new solutions around credit assessment. So I think that's really what we are looking into and really how we approach that. I don't think any bank, and certainly not Standard Chartered, is saying that we're going to solve that in isolation of fintechs or networks. And it's really by combining and joining forces that we're going to democratize really trade finance.
Yeah. Ami, I think you wanted to respond to that.
Yeah, so I think that maybe I can offer another conceptualization about the connection between the digital and the physical. So there are many digital transactions which are being financed, but I think as far as I see with working with many banks, I think, and I just 2 hours ago, I attended the Global Coalition to Fight Financial Crime Summit virtually. It's oftentimes disconnected from the physical transaction. Actually, the bill of lading or the cargo being moved from point A to point B. And I think connecting these dots has a lot of meaning in the big picture, because then you can actually close the full cycle. So, Jordan, I absolutely agree with you with providing financing at scale, but also these cargoes need to get somewhere. And right now, if you say bill of lading authentication, or if you say TBML, or if you say digitalization trade finance, and you really get down to the details, you get to a manual service that somebody does. And I think to really control that at scale, the only way to do this is using AI at scale for connecting every container, every ship, every company, and every entity. And actually, just expanding the scope, one last point is, from the carrier perspective, that's also a huge issue. And it's also a big part of global trade, because all of the carriers need, when you type in on their website and you say, hey, I'd like to move a cargo from point A to point B, they need to screen you in the beginning, and they need to log that and check that throughout the journey, from the outset to the gate, to the ship, to the transshipment, to the final destination. And that's also disconnected from that. So I think, and I absolutely agree with Jordan, collaboration, connecting between the digital and the physical, and then running that through reality and comparing what we think is happening to what actually is happening. And that will get us also to better credit ratings for everybody. Because otherwise, we're all one-time players, and nobody wants to be a one-time player. You all want to be a repeating player, because if you're a repeating player, you have credit rating. If you're a one-time player, it's going to be very expensive.
Ziyang, I think you had a point to make as well.
The transition from physical to digital is a key here. I think we talk about data, we talk about this, we talk about fintech, but we often forget, as I said, global trade is just such a paper-heavy process. And just to, if we want to utilize all the technologies to turn the pile of paper into digital, that's the first step, the digitization, right? When we talk about e-invoicing, electronic invoicing, but in many places, the e-invoicing is just a PDF copy or a photocopy of the actual paper invoice. It's not actually in data and digitized format. So that's really a key step here that we, when we talk about the digitalization of trade or trade finance, we often forget, as at the ports, on the ships, really have to pay attention to that. We had a report out on trade tech, and according to the survey, there are 2 layers of digitalization, right? It's not just one process. The first layer is really, as I mentioned, from turning from analog to digital. Then when you have that data, when you have all the kind of like the foundation, then you can lay, the AI, blockchain, whatnot on top of that. So I think that's important. And another point, I think, just to follow up on some of the discussions going on, we talk about collaboration, or talk about sharing data. I think it's important to provide incentives, market incentives for all the players in the supply chain to share that data. Because we can say, yeah, you should do this, you should do that, but why should folks do it? And we all know the global, again, trade system is complicated in some way by design, for right reasons, right? The banks have, we've seen some fraud issues. So we saw some, big, trade finance companies collapse in this year. So I think it's important to have those checks and balances, but to provide the right marketing incentives, right? So, for example, so that not just the tier 1 suppliers share data, but tier 2 and 3 and 4, right? All the way down the chain. I think that's when, some of the new technologies can come into play that can provide build a trust system and an incentive to share that data. Thank you.
Jordan, you wanted to add something as well?
Yes, I just wanted to go back to that, physical and digital combination, and the solutions such as AI are really meant to enable the various players in that space to process documents in a way more efficient manner. But the other stream as well is how is the industry moving for allowing actually the physical world to become digital, and there's a need there basically to look at global regulatory or legal framework around things like title documents or negotiable instruments, right? The question is, what is the legal enforceability of a digital BL, right? What do we need to have a proper digital bill of lading that gives that acts as a title document? And there's a number of private initiatives in this, but is there a more global to it that could provide a new legal framework recognized by the entire industry to allow title ownership through a digital bill of lading, for instance, or to recognize bill of exchange that would be digitized and would be a negotiable instrument as in its digitalized fashion, right? So that it's really the two streams. One is, how do we process the paper way more efficiently, because it's still there, it will still be there for some time, and we need to make sure we have the right solution in place. And then how do we work on the regulatory and legal framework to make sure that we can actually move from the paper world into a proper digital one with the same type of legal framework around it.
Cathy, I think you had views on this, especially the issue of digital ID.
Yeah, just to compliment Jordan, absolutely. The paperless trade is still not that paperless, and we have to absolutely work on that, particularly with developing countries that have the biggest trade finance gaps. Oftentimes, are the least digitized in this space. We have also done work with logistics providers and payment companies, and seeking to do exactly what Ami was talking about, which is to enable much more fluid transaction in the logistics supply chain that supports any one trade transaction. When you think of the amount of transactions that happen between the beneficial cargo owner and the freight forwarder, and the freight forwarder and the shipping line, the shipping line, the terminal operator and port, there are about 40 different payment events in this transaction. And again, we also need to enable these payments and digital handshakes, if you want, between these different actors. And of course, for that, we also need paperless trade and much more digitized processes. We calculated that the aggregate amount is of these transactions costs are about 30% surcharge on the global freight ecosystem, which is about $4 trillion annually that moves cargo. And for companies, chasing unpaid invoices in this ecosystem is about 10 to 20% of just account management costs. And that results in significant cash flow issues for any one player in the supply chain of logistics as well. So I think, if we were to digitize paper in trade, this would certainly enable trade finance, but we would also enable the automation of trade logistics and save cargo owners, smaller businesses in particular, significant costs in terms of invoicing, billing, chasing unpaid invoices in the system. And this, is a great opportunity for everybody, I think, in the trade finance ecosystem as well.
No, absolutely. Christian, I think you had a point to make as well.
Yeah, so first off, we are very familiar with the interface between the electronic and the physical. We run the B2B process for every single large freight forwarder in the world and most of the shipping lines, right? So, and as part of that, you'll be surprised how many transactions are already digital, right? And just for some of the shipping lines, we're sitting on 50-60% of their complete global billing as electronic, right? So it is happening and has been happening at a pretty rapid speed over the last few years. Now, the question I think is we do need the link downstream to the physical goods, but what we are seeing more and more is actually the financing is moving upstream all the way up to the purchase order, right? Because that's the earliest point of sort of commercial commitment. And it's clear, right? You do want to have the ecosystem that follows, but if you can link that purchase order to the downstream transactions, you actually have an envelope of security that stretches along the whole transaction link. So that's some of the stuff that we're working on right now, where, again, by having the data upstream enabled for the downstream ecosystem, it's much easier, right? Because, and this is another thing we keep saying, we talk about credit ratings. So I just want to point something very, very clear out. Credit ratings are nonsense. They're complete. Most credit ratings today done by banks categorize you into 4 different sizes, very small, medium, large. And based on that, they decide how much money they will lend you. That makes no sense in business. Credit ratings should be on a transactional level. If I'm a small business and I send an invoice to Apple and I send an invoice to, let's say, the window cleaner around the corner, one carries a lot higher chance of being paid than the other one once they're right? So we need to deconstruct the whole credit rating stack and move from a horizontal credit rating that's based on a company entity level to one that is vertical and based on a transaction level. Now, that has never been possible for the banks because we did not have the transactional data in a network. But that's exactly what's happening with most of the finance players we are playing with. They're not looking at us as a per entity credit rating. They're looking at it as a per transaction credit rating. And that's really, really helpful for the whole ecosystem because, again, then that purchase order can provide cover all the way downstream and independently of the credit rating of the players that sits further down. Right?
Ziyang, I think you also wanted to opine here.
Thank you. To both Kadi Christian's point, in our report, we did a survey. We surveyed hundreds of companies on what is the most transformative technology for global trade and trade finance. And number one is IoT, followed by digital payments, followed by e-commerce platforms, and followed by cloud. And then the AI, blockchain, the fancy technologies are actually further downstream. So I think that's just a perfect testament, to demonstrate that we still need quote unquote the basics, right? We need the data from IoT. We need digital payments, to Kadi's point, to facilitate the whole process. So I just wanted to share that, and also quickly interoperability. I think that is a key here, both on the system interoperability, but also regulatory interoperability for companies, both for the different, the software, the data system to talk to each other, as well as, for the different regulatory policy rules to talk to each other, so that for players, especially SMEs, they don't have to deal with because they're in different regulatory regimes that they don't have the resources or knowledge to deal with. So thank you.
Thank you, Ziyang, for raising this. Actually, I was going to come on to that. So, what strikes me listening to you all is we've been talking about these very long chains of transactions and basically highlighting the need for data to be extracted at every step. But that means a lot of different systems that have to talk to each other, and a lot of, I suppose, a big need for standardizing this data in some form at least. How is this going to happen, do you think? Who has to take the lead on such initiatives? How to make sure basically this is done and not everyone is waiting for someone to do it? Ami, do you want to
so I think I think there are two sides of that coin. One is industry organizations. I think a good example in the containerized world is what's called DCSA, the Digital Container Standards Association, that published pre-agreed standards for people to work with. I'm sure there are comparables to that across the industry. But the second is just ease of doing business. So I think technology today allows you to streamline a lot of things that are just easier So and we're seeing this also in the carbon emission space, where the regulators are just too slow to react to what the public expects. So actually, the best answer is market mechanisms. Build a great solution, have an incentive, to echo what Kristen says, for the supplier and the buyer. Allow people to make more money faster, with less friction, less false positives, in a better way. It will all flow. I don't think there'll be one big, powerful Oz that will solve it. There is no
Amy.
spoon, to quote bigger people, bigger than me.
Thank you for that. I think we've run out of time. So unless there are any last words from any of you, I think we probably need to wrap up here. And well, thanks so much. It's been a really fascinating conversation. I wish we could go on for much longer, actually. There's many topics that we covered and need more exploration. So thanks for offering your insights. Thanks everyone for tuning in. Stay tuned for the rest of the conference.